Tonight's topic is particularly interesting and close to our hearts here at the Business School. As I mentioned to our distinguished guests a little earlier on, we are in the process of establishing a Centre for the Leadership of Energy here at the Business School, looking at all aspects of the value chain within energy, oil and gas, renewables, electricity, you name it. We're looking at it from a leadership point of view. So this is very much aligned to what we're talking about this evening.
So today, actually, what I'm going to be talking is going to focus on the oil market, whether the adjustments we are seeing in the oil market are cyclical or structural in nature. There's been a lot of debate on whether this cycle this time is different from other cycles that we have seen. As you know, that in the oil market we have seen actually many cycles before, and this one is actually perhaps would not be the last one. This time is that, for instance, if you look at the mid-1990s, you had the Asian financial crisis. If you look at 2008, we had the global financial crisis. If you look at the January, the 86 events, actually it was the US recession. So there was a lot of, many of these falls actually have been associated with some downturn, very sharp downturn in the global economy. It shows that since the beginning of 2014, every month we've been accumulating stocks. Consumption has been actually going below production. So as a result, more supplies are coming into the market than the world is consuming, and actually we're accumulating stocks. And this has been happening every single day since 2014. But quite interestingly, at the beginning of this year, we also started building stocks in products as well. And that's actually quite a fundamental difference, I would say, between last year and this year, because last year most of the stocks that we were building were in crude oil, but nowadays actually we're also seeing a lot of build-up in product stock, particularly diesel. The question of whether we have entered the world of low oil prices for much longer, or some people actually describe it as the new global oil order, or actually it's oil prices, or another scenario, which is oil prices actually rising sooner rather than later. The US crude oil imports. In 2010, they were just close to 10.5 million barrels per day. Now actually they have declined to less than 7.5 million barrels per day. This is really a dramatic improvement. And if you look at some of the traditional exporters that actually were exporting to the US, that market is no longer available to them. And that actually has intensified the competition so much that all of these producers that actually were going to the US, now they have to divert their exports into one growing area, which is Asia. So that's why we're seeing actually very fierce competition in Asia between West African producers, between Middle Eastern producers, between Russia, and all of that. And actually, the US really was not only about a shock on the supply side, it was also a shock on the trade fundamentals as well. The world has really changed in terms of crude oil flows. So the cuts in capital expenditure that we are seeing at the moment have been dramatic. But it's quite important to remember that many of the projects actually are started coming online because of the past investment decisions. And this is one of the things which makes the oil industry actually is that there are lags. And it actually, the investment decision that you have taken in the high oil price environment actually are started coming through. And that explains why in 2015, despite the fact that oil prices have collapsed, the supply response actually lagged. And if you look all over the world, from US, Brazil, Russia, China, UK, Canada, Norway, all of these countries actually added to the supply. If you look at other producers, perhaps that are off the radar, like China, Malaysia, Indonesia, all of this actually production is already declining. And that is, I would say, is quite a surprise, because we were expecting actually in 2016 for non-OPEC supply to continue, to grow, not very much, but not to decline at the rates that we are seeing today. And the only way that in the past we have been able to reverse those decline rates is by a lot of investment. For instance, if you look at the North Sea, the UK has increasing production, but actually after huge investments, which were facilitated by the high oil price environment. So as you start cutting investment, you're not only cancelling projects as well that are going to bring new production, actually you're cancelling projects that are able to keep supplies at this current level standing still. We thought it was different because of the US shale. If you look at where most of the production growth came from, non-OPEC, it was actually the US. And what we have seen in the US is something very, very significant. The investment cycle is very, very short. And for them basically to achieve what Brazil achieved, they took them 12,000 wells to drill. In Brazil, you have achieved that with 40 wells. That's basically the difference. This is closer to manufacturing activity. The only way basically you can continue to increase production is to continue to drill. And why this is the reason? Because one fundamental feature of the US shale is after it reaches a high level of production, its maximum level of production, the decline rates are very steep. Even in the high oil price environment, most of these US shale firms actually were not making any money. This is the first time that credit market conditions actually can impact production. This idea that we've moved to a world of permanent cost deflation actually is not accurate. Now, why did the market think that Saudi Arabia, or particularly OPEC, is going to interfere to balance the market? Is that Saudi Arabia, since 1986, they have refused to act as the swing producer. And that's basically what they did in 1986. They tried to balance the market to keep prices at a high level. What happened? Their production fell from 10.2 million barrels per day to less than 4 million barrels per day. That was a huge cut in production. And actually they failed to protect the price. Prices continued to go lower despite the fact that they cut production. And that's why the way they responded after trying it for 2 years is by pursuing market share. And I think this is what's happening at the moment. Is Saudi Arabia has made it very, very clear that they're not going to act unilaterally. If there's going to be any cut, it has to be a collective cut. That we're lucky if the world adds 1 million barrels per day. Last year, we added 1.8 million barrels per day. The story is no longer about China when it comes to oil demand growth. What we are seeing is other parts of Asia, other parts of the world also adding demand. The problem is that the world basically was used to a world about diesel. Everything was about diesel. If you talk about gasoline a few years ago, they will tell you that this is actually dead. Gasoline is dead. But actually what we are seeing that most of the growth in the last year has come from gasoline. And diesel demand actually has flatlined. And one of the reasons why this is the case is mainly because of China. As China is rebalancing its economy, we're seeing that demand for diesel is also flatlining. Now, there's no doubt that we are living in a world of what we call, lows. Low growth, low inflation, low interest rate, low demand, and all of that. Okay? And we are expecting actually the growth in demand to slow down. But we're not expecting demand actually to collapse. There was a belief that if oil prices decline by the way they decline, then they should really, we should really have huge impact on economic growth, global economic growth. We did not see that. Producing countries are introducing measures, reforms, and this idea that in a low price environment, actually they are willing to consume more and use their buffers much more quicker. This is not holding true in many countries. So I would say, this is a very interesting question, is why does the oil price decline by 50, 60% and actually economic growth does not respond as fast? But I would say this is a short-term story. The improvement in the world energy intensity between 1994 and 2014, which has been the fastest ever in the history of mankind. Or at least that's what they claim. Even if you assume that, and even if you actually move beyond those improvements in efficiency, according to their base case demand, energy demand will continue to increase. So in terms of absolute values, in terms of the number of barrels, in terms of the gas, in terms of the coal, in terms of everything basically, even with rapid improvements in the energy intensity, still energy demand is likely to continue to increase. Even in a climate-constrained world, what you need to achieve is much, much more than we are doing so far. You really need to change the carbon intensity. Basically, you need to change the energy mix. So for instance, for a country like South Africa, which relies on coal, you know, you need to reduce the coal perhaps by 50%, okay, from the energy mix, and perhaps substitute it by renewables and gas. You need to be very energy intensive, very energy efficient. And those actually are not the things that we are seeing in the real world. The cuts in investment that we are seeing so far are so deep that they will have big impact on future supply, both inside and outside the US.
You did mention climate change, but you didn't explicitly discuss the effects of renewables in terms of disrupting supply.
So that's why I would say that this is actually, all of these scenarios are not scenarios which are assuming renewables are not going anywhere. All of these scenarios are assuming that renewables actually are going extremely fast, faster than what I would say would really expect. So that's it.